The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name is Gaurav Sodhi. Joining me today is analyst James Carlo. Welcome, James.
Good morning.
And with us also is analyst Mickey Morder. G'day, Mickey.
G'day, Gaurav. Hi, James.
So, gentlemen, how are we traveling? James, do you have any of the latest on the epidemic? I do keep hearing that the American experience is getting worse. They're actually lifting shutdowns before the case numbers are starting to decline, and that could accelerate things and make them even worse in many states. But we seem to be traveling pretty well over here.
Yeah, we do. Fingers crossed, really. Case numbers very low. Not much to say, I'm afraid. It does look pretty ugly in America. So particularly, I think it's very patchy over there. And look, I think they don't have much appetite for locking down, and that's gonna maybe get their economy back a bit sooner than otherwise. But it's also gonna, obviously there's the implication of people dying. So
I must say I'm a bit more concerned about America, and I think I've made a concerted effort to domesticate my my own portfolio a little bit more than I ordinarily would, and I've just been a bit more cautious on businesses with big American exposure. But I that's really me being overly cautious, and I'm not sure.
But is that a response to the virus or other things that are going on over there?
No, look, it's really a response to the virus. I'm not convinced that they've handled this particularly well. And
well, they've certainly not handled it well, but I mean that may get them through. I mean, economically speaking, that may get them through sooner rather than later.
Perhaps, even if they don't have shutdowns, I think people's fear of getting sick mean that if you have lots of infections and lots of deaths all over the country, people will naturally change their behaviors, and that will impact the economy, even if the government doesn't have shutdowns and lockdowns. So I'm just a little bit cautious about it.
Yeah, I think, but I think not as much as an actual lockdown. But anyway.
Yeah, no, I'm sure that's the case. Yeah, agreed. Mickey, how are you feeling about all this? You worried? You're feeling optimistic? Share market is on a bit of a
well,
don't know if you've noticed.
Oh yeah, no, I definitely have. It's been great. But I think it's just that the risk has now become normalized, and it's just that panic fear factor is probably not where it was. So it was this big unknown at the start. We had no idea how it would unfold, and now the future just looks a little bit clearer. But certainly still risks for sure, and we don't know what the ultimate toll will be. But it just seems like the market has kind of normalized the situation. And there's probably, also a lot of the companies as well, particularly in the US, have quite international exposure, and the big tech businesses probably won't be as affected, but probably have disproportionate effects on smaller businesses, and so
it's amazed me how much life has just normalized. You go outside, and everything is filled with people. My local train station's parking is chock-a-block all day, every day. Malls are filled. There's traffic everywhere. I'm surprised. You could almost get away with not even realizing there's still a pandemic about.
But there isn't. There isn't.
Well, in Australia there isn't.
That's the thing. Look, okay, you could. Definitions. There's obviously the risk of one, but at the moment, the cases are very, very low.
And yet we're still 20% down off our February highs here in Australia.
Is that right? I don't know. Yeah, something like that.
Yeah, I think that's about right. So look, So it sounds like we're all feeling reasonably comfortable.
Well, I think we're gambling there. It's important to remember that we're essentially gambling on a vaccine still, because we can't keep the border locked down forever. So, in the absence of a vaccine, at some point you've got to open up. I suppose if you open up after it's sort of dying down in the rest of the world, you'll be in a better position. But um, let's hope we get a vaccine sooner rather than later, because it's going to be it has big implications for the economy if you don't let people in or out.
There's a
I've
lot
heard
of pessimism.
really mixed things about the probability of a vaccine, and it's
Yeah, I was
just there's
about to
so
talk about it
much
again.
conflicting information. It's hard to know whether we'll get one, but it seems like we'll probably get some sort of solution. It's just the timeline around that. But
It's a real test of our species. I mean, think about all the resources that are being thrown into a vaccine. I think there are 150 active trials happening at the moment. Every research lab in the world is working on this. Every government resource is being thrown at this. They're simultaneously researching and building manufacturing capacity, even for vaccines that haven't been proven yet. I find it hard to imagine that we won't get a vaccine and get one very quickly. But I mean, every problem that we've ever, as a species, tried to solve, we've tended to solve, given enough resources.
Oh,
And there's unlimited
there's
resources
a
being
few
thrown into
things
this.
we haven't solved yet.
What
But
haven't we solved, James? We've solved every
the
problem.
meaning of life. I mean,
Don't you know?
there's
I'll tell you that after the podcast.
flying cars. I mean, look, there's a bunch of things. I mean, it's
There's a couple of
we've
problems
solved
that
all
ought
the
not to
things
be
we've
solved.
solved. There's a whole bunch of things we haven't even thought about solving.
Well,
So
flying car, the problem there is transportation, right? And I think we're solving transportation. Flying cars is a gimmick that may or may not ever happen.
But I mean, high speed rail. I mean, look, there's a million things, but
Yeah.
you see, it's a question of imagination rather than ability. But anyway, we're getting off the topic. I mean, fingers crossed we get a vaccine, because if we don't, then at some point we're going to have to let some people in.
The other interesting thing, I guess, about it all is just how many retail investors have been flooding into the market, and how short term. I think a lot of the market's mentality is right now. You're seeing a lot of these stocks, like not to say anything. We don't have a particular view on them, but for example, Kogan and Zuno and these stocks that maybe will benefit from increased traffic in the short term. And it seems like everyone's kind of flooding into those stocks, thinking. And away from the stocks that are going to be hurt in the short term. So just seems like it shortened everyone's time horizons a lot, and I guess that's an interesting part of it.
Yeah, I don't know about that. I mean, I think that the people flooding into Kogan's done brilliantly the last month or two, hasn't it? I mean, and that's so that may seem short term, but it may, the argument is that it's increased, accelerated everyone's shift towards online retail, and that Kogan could be a major long-term beneficiary of that. So I'm not sure that's.
Well, I mean, I was just taking Kogan for example, but I mean, that stock, for example, is up. It's tripled.
Yeah. It's hard to see the justification for that. I grant you that.
Now, I know what you're saying. There's a lot of it's a difficult market to read, because professional investors are very cautious. There's a lot of money on the sidelines. I think there was a fund manager survey released recently, and I think 85% of fundies were negative on the market, and most of them had higher than average levels of cash. But the retail side is roaring ahead, and I've seen unbridled enthusiasm, which usually really scares me when you see lots of inexperienced investors making a lot of money very quickly. That's not a good sign. So you got two very different indicators here that point to different outcomes, and I really don't know which way to go. So it's a difficult market to read for me, because I'm not really sure how to take this, but I still think company valuations look reasonable across the board. There are a couple of crazy examples, and I think Kogan is actually one of them. All these high growth stocks look pretty manic to me, and I don't have much money invested in them. I think you can see from our even our recommended list that there's not a lot of. It's not really where we're focusing on at the moment, because it looks kind of crazy. Where we have been focusing on, gents, is we finally published United Malt Group, which is one of those old, boring industrials that no one ever thinks about or even knows existed until we started looking at it. James, did you know that it takes 140 grams of malt to make 1 liter of beer?
Well, I did, but only
Oh,
as a
did
result of
you?
reading your article.
Oh, right,
No,
okay.
no, I didn't know. Yeah, I mean that's a lot. That's a lot of malt. I mean, and it raises the question: is it a bit like cement, where you've really got to make it near where it's needed? Is
Yeah,
that the point? Because they have production in the US as well, do they? Is that also they don't export? You don't export malt from here to the US, do you? Or do you?
no, you don't export malt from here to the US, but what you need to do, you can export malt, and there's a pretty rigorous export market. We actually export to Asia from Australia quite a bit. I think a lot of Asian brewers use Australian um, malt as a key ingredient. But I think the key restraint is getting access to the raw material and then processing it and getting that processed stuff onto some sort of logistics chain, because moving around a low value material, and I think you're right to point out the similarities between this and something like cement, and also things like iron ore or alumina. Those things, they're relatively abundant and they're relatively cheap. So they're low cost, but they cost a lot of money to move around, and that's the same thing with malt. It doesn't actually cost that much money to produce, but to move this stuff around and to get it in volume from where it is made to where it needs to be is a tricky one. So all those businesses, iron ore, alumina, cement, and malt, these are as much logistical businesses as they are manufacturing or mining ones. And
And
you have to have integrated logistics to make the economics work.
And can they not? Does barley need very specific growing conditions? Can it not grow in Asia? Is that why they import it from here?
I'm not sure why, but for some reason, the barley market is rather the barley market sounds like a tourism ad, doesn't it? It is rather concentrated. About 40% of all malt barley is grown in Europe, and then you have big chunks grown in Canada, North America, and Australia, and some in the UK as well.
Sounding very
And
temperate, isn't it? Sounding not the sort of
it's
thing.
sounding like it,
Yeah,
isn't it? Yeah, I'm not
yeah.
sure what the agricultural conditions are like, but it's certainly only a handful of places that grow it in very large volume. And that's why processing facilities are built near growers and then also near end user markets. And it's no
Yeah, where
coincidence
they
that
drink a
North
lot of beer,
America,
I guess,
well,
is the
yes,
other point. Yeah,
Europe
yeah.
and North America are the two huge markets for end beer consumption.
I was
One thing,
amazed by. Sorry, I was just going to say I
no,
was
go ahead.
amazed in
Yeah.
your article. You said that Budweiser had
Yeah.
substituted malt for rice.
Yeah, not entirely. A third of their origination comes from rice instead of malt. For most beers, traditionally, 100% of your initial fermentation ingredient comes from malt. But all the big beers, in fact, all the big label beers, they've substituted malt for other things over time. Partly because malt is harder to get access to, and I'm sure rice is easy to get to. It's also cheaper, and it might be easier um, transporting and things like that. Perhaps it keeps better. I'm not sure, but it's happened across the industry.
Well, I think
Rice,
also.
sugar, and there's one other key substitute which I've completely forgotten. But that happens all
Hops.
around. No, hops. Hops is you add it at the end to
All
add
right.
a bit of bite.
Oh, I
Yeah,
see. I did a bit of reading after reading your article and about temperatures for serving beer. Anyway, it was saying that the beers that you serve very cold,
yeah.
basically it hides the taste. And
Oh,
so the beers, the sort of mass market beers like Budweiser, which tend to be served very, very cold,
yeah.
perhaps you can get away with it, but the sort of more flavoursome, sort of warmer beers that you might serve, perhaps you can't.
Yeah, okay. That sounds
That's a
sounds correct
theory.
to me. I didn't realize that, but yeah, that sounds right to me.
Apparently, the
Yeah,
more crafty sort of beers,
hmm.
the tastier types, you need to serve them a bit warmer because you serve them too cold, you can't taste it.
It's a bit
But
like
but there are some beers that you want to serve cold because they don't taste too good.
you, you guys ever had tomatoes out of the fridge? They taste terrible. It's the
Yeah,
same sort of
no,
thing.
that's
You have to
true.
eat
That is
tomatoes at
true.
room
Yeah, that
temperature,
is
otherwise
true.
it doesn't
Yeah,
work.
yeah.
I don't mind a tomato with a bit of pepper on it. If you just take a slice off, just for
Oh
the
yeah,
listeners at home, if you got one sitting around.
You need salt as well.
I'll
Salt
add
and
to
pepper.
that. You got to put some salt, some pepper, and then a little bit of
Basil.
balsam on it. I think is the way to do it. Geez,
Jeez,
Nicky,
it's
get it right.
getting a bit
You're gonna do
fancy
it.
now. Yeah.
Yeah.
We're getting a bit off the topic here, boys.
So
All
malt.
right, malt. Yes, back to malt. So what I found quite intriguing about this business was that that the size of this independent malt market is quite large and universal. So most beer producers will require a third party source of malt. Um, and because logistics is such a large part of the economics of the industry, it does tend to be dominated by a few large players. And if you are one of those dominant players, the returns here actually look reasonably good. I think there is no reason why this should not be a higher than average quality business. And I'm not sure the market is pricing it as such at the moment. There's a couple of reasons for that. One is that we don't really have very good financial history on the malt business. And it's not obvious just looking through the numbers that it is all that wonderful. But I think as you get specialist management in there, and you get more access to capital, and um, a better reporting history, it will become clear that this is actually a pretty good business. I should point out that there's no other listed maltster in the world, so a lot of the economics of the industry are quite hidden, and it's quite hard to get financial data about how much these businesses ought to return. And over the last few years, because a few numbers, there was 2 or 3 years of prior data reported along with the IPO. That is, I think, a very misleading indication of the ultimate profitability of UMG, because GrainCorp itself had no money to invest in the business, and they weren't really focused on it. So I think we want to keep an eye out on the results and over the next little period here, and I think over time we'll see that UMG actually is capable of better than average returns.
I think the other interesting thing about it is as well, and one other reason the opportunity might be hidden a little bit, is that it looks like a commodity producer, but I don't
Yes.
think it is. It's actually providing, like I think you mentioned in your article, pretty valuable ingredient, and it's got a distinctive ingredient. It has to be prepared in a certain way and potentially changing flavors as well.
Yeah, no, I completely agree.
And it's almost a service as well, which is the point you were making earlier about distribution and logistics being key. So that it's almost it's a relatively small cost to the beer producers, but they need it, and they need it to be right, and and so you're almost providing them with a service, I think.
Yeah, that's a good way to think about it as well. Yeah, I agree. I agree with both those points,
And why
particularly
would you
Mickey.
change the service as well? I mean, if it's such a small percentage of the cost, like
Yeah,
I mean, if it's going right and it tastes right and all that, I mean, unless you're Budweiser, I suppose shaving 0.5% off your cost for Budweiser makes a big difference. So,
I think
yeah.
this focus on the craft sector for United Malt in particular is really important. It's a important differentiator, and it is a source of um, super profits for them.
So, do we know
Because
what portion of sales go to that?
Yeah, there's a third of sales that go to the
Okay.
craft sector at the moment. It's actually larger than the portion of sales that goes to huge international brewers. So independent, it's actually the largest segment inside UMG, but it's also growing pretty quickly. The thing is, it takes a lot of capital to grow because you have to build out really deep distribution networks to get malt to tiny little craft brewers. But once you've locked those brewers in, as Mickey says, it's quite unlikely that they'll ever change a supplier. And you can actually ride the success of your customers quite a bit because you're constantly using malt, and it's unlikely they're ever going to change supplier because of the specific taste characteristics that they're trying to establish as a brand.
Well, and
So
building out that distribution network has to provide a barrier to entry as well.
indeed, yeah, and
And I
they're
guess
doing that at the moment as well.
they're just weak customers as well. They're just small customers, and you're a big supplier, and you can just tell them what the price is, and they can't negotiate with you.
Yeah. There are downsides as well in that when you supply a big customer, so UMG supplies Foster's in Australia, and that's their largest customer in Australia. The revenue it's certainly lower margin, and you're dealing with an enormous. I think Foster's is now owned by InBev, which is I think it's $100 billion. It's a huge business internationally. It's the world's biggest beer business, and they can dictate pricing a lot, but they also take consistent quantities, and they actually take the commodity risk on their own balance sheet. So for a lot of their sales, especially to the larger brewers, UMG is actually a toll manufacturer, so it actually just takes a margin on the stuff that it processes, and it doesn't have to take any raw ingredient or any end ingredient as price risk. Does that make sense? They just take a tolling fee on the volume that they're processing, and the volumes are quite fixed over 3 to 5 years.
Yeah.
So it's a quite an attractive, resilient business in that sense. And then you've got the additional margin and growth coming from the craft sector. So it's a good combination of resilience and growth. And I actually quite like the company. So why didn't we upgrade it, I guess, is the next question. It's because two things for me. One was that there's just a limited financial history to work with. And I just wasn't. I think we can be patient with these stocks. It's only been listed for a couple of months. It's never reported as an independent entity. There's no competitor we can check financial results for either. So I just think it's unnecessary to take on the additional risk of buying now, even though I think the price now is actually reasonably okay. And I think it makes some sense to take a small nibble at it now just to establish a beachhead, and you can keep an eye on the results. And as we get a clearer picture of what the economics of this business look like, and in particular, I'm very interested to know how the cash flow dynamics work, because it's been a relatively poor producer of cash flow, even though the model should actually generate lots of cash flow. So I want to check that as well. Once we have a bit more confidence about the actual results, I think I'd be more comfortable upgrading the company.
Trouble is, of course, that the price of if they put out a few decent results, then the price is likely to be higher as well. So I suppose the answer is one's trading a little bit of risk for a slightly higher price, and sometimes that's a smart thing to do. I would also be slightly nervous about craft beers in terms of their growth. I suspect that's somewhat cyclical. I think in a recession, people are going to get the cheap stuff probably.
Yeah, this is a good point to bring up as well, JC. The craft sector has been decimated by the pandemic. Even though the big end of beer production is actually quite stable, I think they've actually grown market share a little bit. That craft sector tends to make a lot of sales on premise, so in pubs and clubs and hotels. And with all those things closed down around the world, craft sales have disappeared. And these little brewers do not have the financial resilience to stay in business for very long. So there is a risk that a lot of this craft sector could be severely impacted depending on the length of lockdowns. And we want to be mindful of that as well. And you're also correct. I think there's a bit more, certainly more cyclicality in that craft beer sector, because the pricing of craft beer is significantly higher.
Interesting one to watch, though. Anyway, I think that's
and it's great to have such an interesting business listed on the ASX. It was wasted, hidden away within GrainCorp, which I think is a lousy business by itself. And I'm thrilled that it's now listed and on our coverage list.
Thrilled.
You know why? You know what I see coming. You know what's coming up. We're going to be taking a beer tour, surely. That's the next step.
Why, you could do it without me.
Oh, yes, Josh. Poor JC.
Beer days
and then we'll go get a steak as well, just to really...
There's a business I've been talking to Nath about called Experience Co, which is a skydiving business.
You can do that without me as well.
Wow. It's a bit small for us to cover, actually, which is the problem. But there's some interesting stuff going on there as well. But that would make a great combination. You've got your beer research and then your research of jumping out of a plane at high altitude.
Both at the same time.
Both at the same time. Yep. The life of an analyst.
Crikey.
Right. Let's leave UMG there. Mickey, we've got a really interesting activity happening in the telco sector. Tell us what has happened. With Opticomm, if that was too cryptic.
Yeah, no, that wasn't too cryptic. So Opticomm has received the takeover offer from Unity Wireless. So Opticomm was a buyer.
Can you just remind us what Opticomm does?
Yeah, so Opticomm provides last mile fiber networks. So basically, these are primarily for new estates, and so it'll make an agreement with a property developer who's building a new estate to come in and actually put in the fiber to the premises in these estates. Those developers can choose. Generally, it's only NBN or Opticomm, who are the two largest to do it. And basically from there, once it's built those networks, it leases out those networks to internet service providers, and it collects a monthly user fee, and so those fees grow in proportion to its network. And Unity is a business that we've also covered, and Agora have covered that pretty recently, and they do a similar thing, but it's primarily focused on big apartment blocks. And so Unity coming in now to purchase this business will basically merge the second, third, and fourth largest private networks, and you'll get Opticomm's experience kind of in the broadacre new estate market, and you'll merge that with the apartment market share, I guess, that Unity has already developed by buying these other businesses. So
it's a really attractive business, actually, this private fiber, because what happens is that they build, because the NBN, the boundaries of NBN are largely established. When there's new estates, the government mandates they have to have fiber in them, and someone has to go and build it. So NBN can bid for the build, but so can private operators. And Opticomm and Unity have been the biggest competitors to NBN. So they get paid for building the network in the first place. And once it's built, it's a monopoly asset. And then they collect wonderful high margin annuity fees every time someone connects to the internet. So it's a really nice business with a long runway of revenue.
It depends on the type of development, I guess, because new estates are mostly monopolies, because to actually put in new infrastructure, you've got to rip up streets and stuff.
Yep.
Whereas apartment blocks, it's a lot easier to get another provider in there.
True.
So I think the merged entity is actually probably going to be of lower quality than, say, Opticomm, but it will probably make Unity a better business as well. And you'll get those scale benefits. They'll be able to share networks, and I think just having a larger network should mean that they can attract one of the detractors for a developer looking to get Opticomm in has been that they haven't been able to get Optus or Telstra to use their network, and so now with this increased scale and more users available, that should help attract Optus and Telstra, and so that should just make this network more attractive overall. Yep. So there are definitely some good reasons. It's pretty disappointing, I from my perspective, because I thought Opticomm's really well placed, and I was hoping to hold on to it for a really long time. So it seems like it's finished way too early. I mean, the business listed only last year, and it's only at a small premium to Friday's close. So it's a little bit disappointing from my perspective.
And when we upgraded it, when was that? Was that before? That was before the pandemic. So we're getting a slight improvement on that price, but after the pandemic.
Well, I think it's from our price. It's up about 30% or something from there now. So it held up pretty well throughout the pandemic, because it was never really going to be all that affected. The main issue from the pandemic is just the effect that will have on the housing market, and that's going to slow down new developments. And so Opticomm comes in right at the very end of the cycle, because it's basically the last thing you put into a development, and so there will be a lag. But you'd think that
so growth could have been affected a few years out, but not in the immediate future, is what.
Yeah, I think growth will be affected. Because depending on. Yeah, I think growth is probably and also you've got this new. There's been a broadband regional broadband tax that's being implemented. So I'm not sure if this is part of the motives for the insiders kind of selling out now, but earnings are probably likely to, stay pretty flat for the next year or two, and maybe they just saw the opportunity to get out now, basically.
Yeah, I would agree with that. I actually had a buy order sitting in for Opticomm above our own recommended buy, I might add, because it was just very hard. It's pretty tightly held, and I found it quite hard to get stock. We held it in the portfolios as well, Mickey, I believe.
No, we never bought it for the portfolio.
Well, it's probably because it was very hard to get stock, is my guess. Yeah, but I'm surprised that management, who owned a big chunk of Opticomm, has decided to sell at such a modest price. Does that worry you at all? Does it signal that there might be difficulties in the business?
Yeah, it does worry me. I think you've got to look at it like any other big sale of stock by management, because there's a script component to this offer, but we don't know if management's going to be taking up that option personally, and the script is only 20% of the total offer. So you think at least you're looking at 80% sell down for the insiders here, and that comes after the IPO and comes after a couple of sales in between. So this is basically them getting out of the business and walking away from it. They may stay within the business, but by and large, they'll be selling down a big portion of their holding. And so I wonder if there's something maybe that they're worried about. And, so you look at, the Bush tax, you look at the virus and how that's affecting potentially new developments. There's also this review going on in telecommunications, which could allow NBN more flexibility on pricing and actually building over other networks. And so that has a potentially to kind of unleash the NBN, make them a stronger competitor as well. So I'm wondering if they're just looking out at all these things and they're going, now's a decent price, decent time. They've been in this business for 15 years. So, but I still for me personally, I would have preferred to probably hold on for a bit longer, but I don't know. So I guess the only other question is if someone else comes in and makes a higher bid, but I don't know.
Well, if they don't, that also tells you something, doesn't it? If we think it's a very low price, yet the insiders are going for it and no one else wants to pay more, then
indeed. And
yeah.
Unity,
so,
I must say, go ahead, Mickey.
Oh well, yeah. So I guess that makes it interesting, in terms of Unity, because they've bought this business now, and maybe they're. Well, I mean, you probably have a better idea, but I guess they've sold the market on this high growth roll up story, and if they're not going to get much earnings growth out of this business for the next year or two, then that could potentially be disappointing, I guess.
Unity worries me a lot. There's red flags all over this. I don't like the way management are being hailed as M&A gods. I think that's really dangerous. Every time you get a lot of growth from M&A and the market starts pricing in your skill as a corporate operator, it's historically ended in disaster. And that seems to be the case here. So Unity was already being priced at a similar level to Opticomm, even though it was heaps smaller and nowhere near as high quality. And to me, that signals that the market was behind the two fellows running Unity, who had this very grand M&A strategy of growing by acquiring lots of other businesses. And they've certainly delivered on that. But you look at the acquisition record, and it is not terrific. They started off doing fixed wireless, which is I'd argue, a poor quality dying business anyway. But as they tried to expand in that area, they couldn't get deals done. And then they went off and bought a whole heap of unrelated niche businesses that have nothing to do with anything really, and they can't really grow. And then after that, they stumbled across this private fiber network, and now they've bought Opticomm. It just seems to be their key determinant of an acquisition target seems to be just size. I think their objective here is just to get big. It doesn't seem to me that there's all that much thought gone into what kind of business they're trying to build. They just want to get big, and they want to get big fast. And that's what.
And then probably they want to be taken over, don't they?
And they want to be taken over is also my guess. You're correct. Yeah, because that's the playbook of Vaughan
Make it easy for someone else to buy up a lot of fibre in one go.
Yep. So Vaughan Bowen was the founder and MD of M2, which was rolled into Vocus, and he gets a lot of kudos from M2. And we were investors in M2, and we did very well out of it. But look, you have to say, M2 was no great business. He bought customers, paid a lot for them, and then was either lucky or skillful enough to sell M2 to someone else who's now really struggled with it. This hasn't been a business that's actually performed well over time. So I'd say that the management is getting a lot of credit for something they have not yet generated a track record for yet. So I'm quite skeptical of Unity. And you look through their presentation, and the key rationale given is to get bigger. We're going to be $1 billion business. We're going to go to the index, and fund managers are going to have a look at us.
Yeah, I
These
agree with
guys,
that. Yeah.
these guys are interested in getting the share price up. They're not interested in building a business. And
I saw it as well. The other thing in one of their presentations was they were talking about free cash flow. So they've got this free cash flow number, and then kind of the asterisk is it says free cash flow is EBITDA less capex, and so that totally ignores interest and tax,
unbelievable,
which is not free cash flow.
Not to mention that EBITDA is not cash flow.
Yeah. I mean, so it's it seemed like a bit of a stretch, really.
Yeah, which is a real shame because as I said, I really liked Opticomm, and to see it rolled into here is a disappointment. And we're not going to. Well, I can say now we're not going to recommend Unity. It has to get a lot cheaper because I think it's there's a bit of mania around this business now, and I don't think it's deserved.
So we've got the Opticomm article coming out shortly, so any interested members can read that.
Which brings us to JC, Iress, which I must admit, I've always heard it's a great quality business. It's this technology stalwart that's, there was a hot tech stock before there were any other hot tech stocks. I don't know very much about this company at all, even though we've covered it extensively, and I think we've recommended it in the past. Is it as good as its reputation would lead you to believe?
Well, it's funny. I've never heard that reputation. Maybe you came at it a little bit before me, but while it was still a hot tech stock, I've been sort of loosely watching it since about 2012, I suppose, and by that stage, it was already sort of falling off its perch a little bit, I think.
Oh, I see. Okay.
So look, I mean, it is a very high quality business, I think, for various reasons, but it's in a difficult area. And it's not really growing very much. So those are the things that so it started off in the 90s making a financial markets software product, which we use at Intelligent Investor, and which is become almost ubiquitous across the industry. Huge market share for providing market information, just sort of in a niche below Bloomberg, but more sort of finely tuned towards below Bloomberg in terms of price point, but more finely tuned towards the Australian market. There's a trading system in there as well, and so and that came from very little. It came from nothing in the early 90s to being ubiquitous by sort of the mid 2000s, which is so certainly if you bought in, I mean, it 5-bagged from the 2000 float to 2007. So
Wow.
certainly it was a hot stock back then. I mean, it did brilliantly well. It was high margin, earnings. I think up to 60% in the margins in the financial markets software business. The trouble is that it became a victim of its own success. So it once you sort of take your market, then it's hard to get growth, and particularly in the financial markets business where the big players have been consolidating and reducing staff numbers. There's been pressure on fees and all that sort of thing for fund managers. So and brokers have been under pressure. So it's a great business, but in a difficult industry and it has very limited growth prospects. Plus, the margins been coming down on that business over the years. So profits have actually gone backwards. So in 2003, it bought another really, really good business, which is Xplan, which makes software for financial planners.
Is that in the
that's
UK?
no, but that's in Australia.
Okay, right.
Although they've taken it into the UK subsequently, but that was in Australia back then. But they and that's done something similar to the financial markets business, which is it's grown and become a victim of its own success. So it now has over 50% market share, and it's now sort of fully exposed to the problems that the financial planning industry is facing. With planners leaving the industry and all that sort of thing. And so, it begs the question: can you have a quality business which isn't growing? And the answer to that is obviously yes, as long as it's producing cash and you're not paying too much for it. So, but Iress was sort of always priced for growth. It had got used to growth.
Yeah.
And shareholders rather expected that, I suspect. And so, where do you go? And so they went overseas. So they started businesses in South Africa and Canada, and bought a big financial planning software business in the UK in 2014 called Avello, which they're trying to shift the customers over to Xplan. But that's been pretty slow going. I think 27% now of UK revenue is Xplan. That's 6 years later. So it's as the contracts sort of renew, they try to sort of shift people over. And these are sort of lower margin businesses, and they're I think they're not as good as the core. And yet they've pretty much provided all the growth for the last 10 years. So without those acquisitions, EBITDA would have barely moved over the last 10 years. And even with the acquisitions, because of the dilution from the share issues to pay for them, earnings per share, I think, has increased from 35 cents to 41 cents. So it's pretty
modest growth.
Slow moving. Now, that might be okay, except for the fact that the current PE is about 28. Which is the sort of multiple you put on a growth stock.
Although 30 is the new 20 now, isn't it?
Yeah, I guess it is. And that would be okay if you were growing a bit. I mean, there's a justification for high multiples for growth stocks because of low interest rates and all that. But that presupposes that you are growing, which they're not significantly. It's a percent or two a year.
Do you think
and there are risks as well.
Do you think there's a difficulty when a formerly high growth business suddenly finds itself without growth? Culturally, do you reckon that's quite hard to adapt to?
Well, I think that's right, and I think it's an interesting. So I suppose it's a question of whether demand for your product is growing, or whether you're just taking market share. And if you've got a static market and you just come up with a great new product for it, then you run into trouble when you take that market. The better growth story is one where the market itself is actually growing and there's room for everyone. And I suppose that's what makes the industry a bit of a tough one.
I find it interesting though with these businesses. I think like Class is kind of a similar one. These software businesses where the addressable market's quite small and quite well defined, and that can actually make them harder to compete with. But it also just means the upsides maybe less. And because it would be so hard for somebody else to come into say Iress's markets and try to compete with them, wouldn't it?
Well, yes, it would, except that, ultimately, I mean, the chances of that happening are probably greater than them suddenly finding a whole new other market, if you see what I mean. So the risks start to be on the downside. If you're someone could come up with a new software product which just does everything much better. It's certainly not impossible. That's what they did. So you couldn't rule that out. But the chances, but the limited growth means as you say, the upside is more limited. So you got to be careful of paying those high multiples.
Yeah.
I mean, it produces good cash. I should say, there's a lot to like. The management, we like the management. The guy running it, Andrew Walsh, he's still, he's the guy who he co-founded Xplan back in the day. So he's, knows how to start and run a business. And it generates plenty of cash. It's a nice business, but it's priced very high for something which isn't growing much.
So, JC, if the legacy business is actually quite decent, then I assume that there's a price for which you'd be quite happy to pay. When would you consider upgrading this one?
Well, I think it's the sort of thing you might pay around 20 times for, that sort of thing. I mean, that's a fairly low multiple when all the earnings are coming through in cash and it's not growing much. We paid 24 times for it when we upgrade. So we upgraded this back in 2010. So it's been sitting there for 10 years. We've basically performed in line with the market in that time of 7% total return. But that's been helped by the multiple going from 24 up to 28. I think you'd want to buy it on a much lower multiple. So, I mean, it's certainly one we'd reconsider, but there's no obvious sign of that happening at the moment.
Yeah,
so,
no, it's
not
hard to
one worth
imagine
covering.
a business like this going for 20 times, isn't it?
I think so, yeah.
Yeah. All right. Well, gents, anything else we need to add, or shall we wrap up? Silence? Okay.
Enjoy your tomatoes, everybody.
Done and done. Oh, I'm going to go do some now, actually. You reminded me. Yeah, tomatoes and malted beer. Just what was called for.
Skydiving.
And maybe a bit of skydiving. Well, Mickey, thanks very much for your time today.
Thanks, Gaurav. Thanks, James.
JC, always a pleasure.
Always a pleasure.
And for everyone else, thank you for listening.